Hey everybody, Brian here. It is Wednesday the 25th of March. Let's look at this market. The S&P 500, as we know, midday was still below that 5-day moving average, and we had expressed a lot of caution on this market as the prior level of resistance that we were hoping would hold as support failed to hold, and the market continued lower throughout the day down to the lows of the days where it closed. And for almost the entire session, take out about 20 minutes, we were below the volume weighted average price, and the volume weighted average price was declining all day, so there's no reason to be a buyer. We look for potential levels of support, and when we approach that potential level of support, then we start to look for evidence that the buyers are gaining control, and it doesn't make sense to be a buyer when the market is below the declining volume weighted average price. That's something we talk about every single day, but I still get questions, hey, does it look like a buy here? And the answer will always be the same, no it does not. Same goes true for the 5-day moving average. When we're below a declining 5-day moving average, we might get a bounce, but it does not mean that you definitely don't think that that rally would continue to hold. The daily time frame, we were talking about a potential for a measured move objective. Point A here to point B equals generally point C to point D. So the height of this added to point C gives us that projection up there. And as I always say, this is what I don't like about price objectives. It gets people to look at it and say, well, it should go to 217, 218 or whatever the number is, and they forget about the most important job. The most important job, as we know, is risk management. When we have a break of resistance and then it holds as support, and with a rising 5-day moving average, we look at the market as innocent until proven guilty. But when it breaks support levels and gets back below that 5-day moving average, that tells you you've got to move to the sidelines and take your profit from that move before it is completely eliminated, which would have happened if you continued to hold the S&P 500 looking for this. This just gives us a reasonable estimate of what could potentially be upside target. So, I get asked all the time, where's the support? Where's the support? I don't know. Nobody knows. We have a bigger band of importance in this area. We have the year-to-date volume weighted average price we're coming back down towards again, and the 50% retracement of the year-to-date range. If we take a look at just the recent action, you can see here that from the recent low to the recent high, we've pulled back more than 61.8%. So that tells us, as far as Fibonacci goes, that this has been a failed move. Anything beyond 61.8% is considered failed. So let's not be looking for where to buy this market, because it's going to take some time to settle down. Instead, let's look at it as guilty till proven innocent. Yes, it's likely to get a bounce somewhere in here, but it's foolish to try to guess where that bounce will occur. If you're a very short-term trader, you can speculate on a 1-minute time frame, but with the market below volume weighted average price, it's declining. It does not make sense to be a buyer. So hopefully that's clear. The NASDAQ 100 also gave back some pretty good ground here today, getting down through the 20, the 10, and down to the 50-day moving average. And there's no guarantee that it's going to hold there. We had prior support in this general area near 105, but there's nothing to guarantee that it's going to hold. We can't look at it and say that is support. It was support before. Things change. This time it may not hold. If we take a look at the volume weighted average price, the Fibonacci in here for the NASDAQ year to date, we're at a 38.2% retracement, and the year-to-date volume-weighted average price seems like it should be, reasonable to think it could be tested. I wouldn't say short it here, though, not after this decline. You want to short after, in a decline, after it rallies and begins to turn back lower. To sell short here, yes, you might make money, but the odds are terrible because it's traveled so far and expended as much energy as it has, plummeting through these potential levels of support that we spoke about. So again, they're potential levels of support, and you could have looked at this and said, oh wow, that's it, that's the bottom. But when you look at the 1-minute chart, there was no evidence that the buyers were gaining control. It was still showing lower highs here, and then it broke back down, and as it should, with a declining volume weighted average price. So don't be the sucker who buys into the weakness. The Russell 2000 gave back some good ground as it broke that prior support level, as we spoke about yesterday. There wasn't anything here to indicate it was a good low-risk short opportunity. However, we do have hindsight to say, hey, wouldn't it have been great? But you know what? That's what losers do. Woulda, shoulda, couldas. That's not what the market is about. You don't get paid on woulda, shoulda, couldas. You get paid on action, and we get paid on low risk, high probability setups. If you sold short yesterday, congratulations. I don't think it was a good place to sell short, except your result was good, but the opportunity did not present itself in a low risk way. So again, it's about being comfortable with trend trading and realizing that no one gets all of the up moves and no one gets all these downward moves either. But if you are patient and you're disciplined, there's very good opportunities in between. Now, as far as the recent rally strength in here, we're getting down to the 61.8% retracement. That may be important tomorrow. We'll see near about 122 and a quarter. But if you look here at the 30-minute time frame, we're below a declining 5-day moving average. We're coming into potential support, so maybe we're going to bounce back up towards 124 and then continue lower. But you don't sell short after such a big decline, and we want to wait for the odds to favor on multiple time frames. We simply don't have that. We were correct in being cautious and observing what the risks were in the market, but it doesn't it's better again to be on the sidelines in cash wishing that you were in than it is to be in and wishing you were out. So defense is a strong role, a strong part of obviously being successful in the market. And right now we have to look at it and say we need to play a strong defense. The semiconductors are down through that 5-day moving average yesterday, and as we identified, these were the weaker group, these in the financials, and we plummeted here today. Any level of prior support, potential support we were talking about at this level, if you bought it, you were buying blindly. There was no real reason to purchase there, and in my opinion, you got what you deserve for selling short when the market said we're only at a potential level of support. It blasted down through all of those levels. So again, there's no reason to be, it's better to be late and right than it is to be early and wrong. So now maybe we're looking at a measured move in this direction in these markets where, the height of this, where we have 58.5 down towards 55, 3.5 points, subtract that from the 58, and we're basically below that measured move objective as well. So, you have to be flexible in the market. We stress that all the time, that we come in and say what's most likely for the market, and we did identify that it was time to be very cautious on this market yesterday, and for good reason. We broke the 24.35 to 24.20 level in the financials. That's definitely not a good thing, and we obviously once again see that this general area of resistance has been halting this market and is too much for the market to overcome. We broke below the 50-day moving average, which is flat. There's really simply at this point, I don't see the reason for for getting long, and you can't sell short after the decline. So sometimes cash is the best position. When we talk about Apple, we've been talking about this one, saying it's below a declining 5-day moving average. There's no advantage to being a buyer. Someone asked me today in the trading room, I think that support is at 124.50, and I said, well, you think the market doesn't care what you think or I think or what a potential level is. We wait for evidence that the stock is actually finding support, and then if it can show some strength and get back above that volume weighted average price, perhaps it's a purchase. And it stabilized there for a little bit, but it had lower highs and then more repeated tests of support. It broke down, and as it should with a declining volume weighted average price. So I don't know if that person bought at 124.50, but if they did, honestly, you got what you deserved, and I tried to warn you. It doesn't mean it's going to happen every time, but this is something that we need to be aware of. The consistent methods that we talk about day in and day out. You're not going to get in at the turning points. You're not going to, we're not looking to buy the lows or to sell the highs. That's not the purpose here. What we're trying to do is get a piece of the trends in between when they present themselves to us in a low risk, high probability way.